All right, before we jump in, let's get the important stuff out of the way. This is purely for educational purposes, okay? It's not financial advice. You've always got to do your own research.
All right, let's get into it. Today, we are going to pull back the curtain on the PLAZM defense economics. We're going to look at exactly how these buy, burn, and build pools, the BBB pools, are designed to hold the line and sustain the floor price right when it matters most, as this storm passes through. So, here's what we're covering. We'll look at the sustainability gap, talk about this storm mode strategy, check out the runway we have to survive, and see how it's all being actively managed. Then, we'll peek at what life looks like after the storm and wrap it all up with what this calculated bet is really all about.
Okay, first things first, the sustainability gap. Let's not beat around the bush. We're going to look at the numbers head-on, with total transparency. So, this is the question on everyone's mind, right? Can the defense actually sustain this pace? It's a fair question. The deployment is aggressive, and people are looking at the math and wondering, does this add up? Well, the answer isn't a simple yes or no. It's actually way more interesting than that. And here's the raw data. The picture is pretty clear. Right now, on a typical day, the pools are spending about $1,757. But look at the other side. The income from yield is only about $300. You don't need to be a math genius to see there's a pretty big gap there.
So you do the math, and what do you get? A daily deficit of around $1,457. Yep, the system is spending way more than it's bringing in. And look, on the surface, that looks bad. It looks like a huge problem. But what if it's not?
Because here's the twist. This deficit isn't a flaw in the system, it's a feature. This is a deliberate, temporary strategy. Think of it less like a weakness and more like a weapon that's being used for a very specific purpose. And that brings us to the heart of it all, the storm mode strategy. This is the why. This is the reason the protocol is fighting its hardest battle right at this very moment.
Okay, this timeline right here, it's the key to understanding everything. All this pressure we're feeling is coming from scheduled token releases, pre-planned unlocks. We are right in the thick of it, in what's called the peak pressure window, leading right up to the final big cliff on day 94. And a cliff is just a word for a big one-time unlock of tokens. But look what happens after that day. The pressure starts to drop off, a lot. And by day 118, things normalize. So all this aggressive spending, it's timed perfectly to deal with this temporary storm.
So the whole strategy breaks down into 5 clear phases. Step 1, absorb all this intense sell pressure. Step 2, use this as an opportunity to permanently burn supply. Get rid of it for good. Step 3, and this is the big one, just survive this window. Get through it. After that, step 4 is to rebuild the pools, and finally, step 5 is to get back to a normal, sustainable diff rate. It's a clear, sequential plan.
Okay, so if the plan is to burn through reserves to get through this, the obvious question is, do we have enough in the tank? That brings us to our runway analysis. Let's see what we're working with.
First, let's look at the E-share pools. Now, these are the ones that get filled up by new entries into the protocol. At the current high burn rate, we're looking at a runway of about 39 days.
The USDC pools are a little different, though. They get some help because they're partially refilled by the daily yield that's generated. So that gives them a longer runway, about 55 days, even with this aggressive spending.
And here's the bottom line. When you put it all together, there's absolutely enough runway to get us through this tough spot and well past day 118, which is when things calm down. Look, it's not an endless supply of cash, but it has been calculated to be just enough to win this specific fight.
But this strategy is smarter than just, setting a burn rate and walking away. It's an actively managed defense. And that flexibility, that's our key weapon.
And we can see this in action. I mean, just look, a few days ago on day 87, the buy and build rate was cranking at 7 to 8%, but now it's been dialed all the way back to just 1%. That's a strategic move to save ammo for the final push. The system is adapting in real time. To really put this in perspective, the current storm rate for the buy and burn USDC pool is 4%. A normal, sustainable rate for the long haul, that would be more like 1.1%. So yeah, we are intentionally running almost 4 times hotter than normal, specifically to fight off this short-term threat.
So, what happens when we win? What does life look like after the storm? Let's project that out, because this is where all that aggressive action starts to really pay off.
Well, the biggest change, by far, is the pressure just evaporates.
After day 118, the daily release pressure is expected to be less than $3,000 a day. That is a way smaller fire to put out. It makes sustainability not just a hope, but a real probability.
And with so much less pressure, that daily yield we talked about becomes a lot more powerful. The numbers suggest that even with just a little bit of growth, the yield alone could cover about 12% of that remaining pressure. The rest can then be easily handled by the pools, but at a much, much lower and totally manageable rate.
So it all boils down to this, the calculated bet. Let's wrap this all up and put a nice bow on the entire thesis.
This table really says it all, doesn't it? On one side, you have the facts we've been honest about from the start. Spending is higher than earning, and the pools are going down. But on the other side, for every single one of those facts, there's a strategy. Defend the floor now, burn tokens while the price is low, dial back the rates when the pressure eases, and rebuild everything after day 118. It's a clear, direct response plan.
And that's where we are right now. This is not business as usual. This is an active, intentional, and temporary state of defense. Storm mode is on.
Which brings us to the final, most important takeaway. This is not infinite sustainability. This is calculated aggression. The protocol is burning reserves to hold the line. The bet is that floors can be defended long enough for the storm to pass. That's the strategy. Now you understand the math behind it. And finally, just to wrap up, please keep this disclosure in mind. This whole strategy we've walked through is based on the data we have right now, and of course, it comes with significant risks. Nothing is guaranteed, and market conditions can change in a heartbeat. Thanks for tuning in to this breakdown.